Okay, let's get started. I'm Scott Lichman on the board of Impact Capital Forum. Thanks to all the members and guests today who have joined us to listen to a great talk about the effect of climate on risk management. We have Therese Feng and Stacey Swann, and I'll tell you more about them in a minute. First, Impact Capital Forum is a platform that allows for education, collaboration, and thought leadership in the impact investing and the social enterprise spaces. We have a number of webinars put on each month, and there are 3 more coming up. One on a related topic about water management and net zero water management and impact investing. Another about the performance of ESG portfolios in volatile times. And a third one with the so-called father of Opportunity Zone, Steve Glickman. So please come to our website, impactcapitalforum.org. Visit now, you can register at any time. For today's event, we have Therese Feng, who is Vice President of Research at the Climate Service. The organization uses world-class science to monitor and manage the financial impact of climate on business investments. Therese brings 20 years of experience in finance to the role. She's performed prior research in environmental economics, and prior to Climate Service, she was Senior Vice President of Global Risk Strategy Management at Jefferies. Stacey Swann is CEO of Climate Finance Advisors. She has more than 2 decades of experience in finance, fund management, and development, including running $750 million in donor funding through the International Finance Corporation for climate smart investments. The event is being recorded, and members and guests will have an opportunity to see that if for folks who weren't able to make it this first time. We will share some information at the end of the event as well. And during the event, you'll see an opportunity to use the Q&A box to fill up questions. Most likely, Therese and Stacey will get to questions about halfway through the event, but feel free to queue them up as you like before then. And with that, I'll turn over the event to Therese. Please go ahead.
Thank you so much, Scott. I really wanted to thank Impact Capital Forum for inviting me to speak. I wanted to thank Scott for all his great work kind of ushering us through this process. And I also want to thank Stacey Swann for joining me to talk about this really interesting area. So this is a 2-part talk, and I'm going to focus on climate risk measurement and analysis and kind of the insights that this type of analysis provides. So I'm going to start by talking a little bit about why measuring climate risk is so important, but let me clarify that I'm really focusing on climate's risks to investments like properties, companies, financial instruments, integrated portfolios. So we're focusing on climate's impacts on these assessed assets rather than how your portfolio holdings might generate climate damages. So here's the question: why is understanding climate risk important? Well, if you're joining this talk, I think you recognize that climate risk is really investment risk. And although the markets aren't yet really fully reflecting these risks in pricing, I think the impacts of acute and chronic climate developments are already having an effect on company finances. So S&P in 2018 did an analysis of the materiality of climate risks for companies and in the S&P and 500, and they found for companies that disclose, the average risk to their earnings was about 1 to 13%. And I think as the volume of climate change disclosure, climate impact disclosure starts to accumulate, I think we're going to see eventually kind of a critical mass that is going to be increasingly reflected in pricing for different sectors, although it's going to be kind of an even process and, at different times. But what I think is really increasingly clear is that there are so many different pathways that climate change has, and these adverse effects are growing over time. So you see impacts on physical assets, on human health and productivity, but also on supply chains, consumer markets, essential services like electricity, infrastructure and transport, and inputs like water quality and availability. At the same time, there are emerging risks and opportunities like carbon-related costs and litigation and reputational risk, and conversely, energy and water efficiency gains. And having a comprehensive view of these risks is actually really important. I think it's also really important to note that in the market, we're really seeing a convergence of key actors that are seeking risk information and disclosure. We see government regulators taking a more proactive approach to seeking to quantify and value climate change to understand implications to financial stability, whether it's the BOE or the ECB. We have Australia's largest financial institutions joining up to develop climate risk modeling standards. We see the Canadian government requiring companies to commit to TCFD, which is the Task Force on Climate-Related Financial Disclosure. They're saying commit to this climate disclosure if you want to get government stimulus financing. And then, we have investors who really want to understand the effect of climate change on their investments and who are applying pressure to asset managers. Then the asset managers wanting to understand what their options are to engage with the leadership of the companies that they're investing in. And then the companies and other financial institutions just simply wanting to understand where they're at risk. So against this backdrop, the question is, how do you measure climate risk? And forgive me if I'm going over ground that people understand already, but I think it's kind of helpful just to kind of walk you through this. We start by distinguishing physical risk and transition risk. Again, this is along the lines of the task force on climate-related financial disclosures. And physical risk is just as it sounds. It's the range of impacts that come from both chronic effects, this is like rising temperature and increased drought, as well as more frequent and intense acute impacts. And that's things like wildfires, coastal flooding, storms, hurricanes, inland flooding, and so those acute events which tend to be highly visible, often catastrophic types of events. Now, in contrast, transition risk are those risks that are associated with the transition to a low carbon economy. So most obviously, this would be increased costs with carbon taxes if you have a relatively high carbon footprint. But it's also reputational and litigation risks, stranded assets, and other risks. And typically, what we see is that transition risks interact inversely with physical risk, not on a one-to-one basis, but generally, the intuition is that the more proactive that corporations and governments and individuals are in reducing carbon emissions, the lower the magnitude of climate-related physical impacts. So investors want climate risk measured in financial terms. They want a value at risk that's comparable to expected value, or expected value at risk. So what they want is what's the values that are at risk for assets on the balance sheet, or to net income and cash flows, or to any other metric of value, but it has to be in financial terms. And especially for financial instruments, you're interested in pricing the effects either through changes in valuation, dividend flows, or changes in default probability, and ultimately the cost of capital. Now, the risk estimation process that we use relies on an insurance approach, which is the first thing you do is you quantify what the climate hazards are. And these are, when I say hazards, I mean these individual climate variables, the acute and chronic, the probabilities of extreme temperature, coastal flooding, et cetera, that I've just talked about. So you want to quantify these and identify what their magnitude is at specific locations. And then the second thing is that you want to characterize the vulnerability of physical assets. And then given the valuation of these assets, you're going to measure risk as the interaction between these two, or basically the impairment of value due to climate hazards. Now, I'm kind of oversimplifying it, but I think that sort of clarity really does sort of give you a sense of the basic intuition of how we model climate risk. Just to provide a little bit of background detail, what we at Climate Service do is we rely on about 23 climate models, which have been developed by the World Climate Research Program and the Intergovernmental Panel on Climate Change. And these trace several climate variables for different scenarios of global warming. And then we localize these variables using data from NASA mostly. So that provides you a sense of, the local climate variables. And then these are specific to two different, well, at least at this point, we're using two different global warming scenarios. RCP 4.5, which corresponds to about 2 to 3 degrees of global warming, which is close to that which the Paris Agreement would achieve. And then RCP, and RCP means representative concentration pathway, 8.5, which corresponds to about 4 to 5 degrees of warming by 2100. So you can think of RCP 4.5 as kind of an eventual stabilization of emissions at a sort of lower level. I mean, not lower level compared to currently, but just lower level than if you did absolutely nothing, because of stringent measures that would limit emissions, accelerate changes in technology, and achieve some sort of carbon capture. Whereas RCP 8.5 would be a higher baseline emission scenario because, nobody can be bothered. So both of these scenarios are, at this point, pretty attainable, depending on what people decide to do. And, I think it's important to have actually a range of different scenarios because we're not clear on what the future pathway is likely to be. So now, with all these climate variables localized at specific points in the world, we then map all the physical assets of an entity. So if it's McDonald's, you're going to map all 38,695, at least as of sometime in 2019, restaurants in the world. And then you model the vulnerability of that restaurant, not each individual restaurant per se, but in other words, sort of that prototype restaurant at that location, you're going to model what the vulnerability is to different climate hazards. And how we do that is we look at all the pathways that climate change can inflict damages. So for McDonald's, that's going to mean things like lower labor productivity of their employees, flooding damages if they have coastal restaurants, wildfire damages, especially if you're in, say, California or Australia, damages from storms and cyclones, higher air conditioning costs, higher costs for agricultural inputs and water, and sensitivity to drought and water stress. And, for not so much for McDonald's, but for other types of assets, you would also want to capture things like changes in the consumer market. Let's say you're Disneyland and you're looking at, heat, extended high heat periods. That's likely to have a significant effect on visitation. So the pathways are different for each type of physical asset, whether it's a data center, a refinery, a crop, or corporate headquarters. And so then each of these vulnerability or impact functions which you're using to model the vulnerability are different. So then finally, you put these hazards, these localized hazards, climate hazards, and the vulnerability functions together for each asset to calculate the value at risk. And keep in mind, this is a distribution of values for each climate scenario for a given time period. And then you sum this all up, and then this value distribution is the value at risk. So, and then, you take that a little bit further and you calculate what that means, at least if we're talking about listed equities, what the price of, prices for a listed equity or a corporate bond. The same process in general terms applies if it's a, it's a property or, infrastructure, or sovereign bond. It's a similar process. And then, if you're looking at your portfolio, you're going to do this for each company in your portfolio. So what I'm going to do now is we have this nifty platform, which I'm going to share. And I think what I want to do is share this platform sort of to illustrate some of the insights that this type of modeling generates. So here is a sample portfolio of 10 equities where we've used public information to calculate the risk from climate change. As you can see, here's these 10. And the date is 2020. And basically, when I use 2020, what I'm really meaning is 2020 to 2029 is being modeled. The scenario is the high emissions scenario of RCP 8.5. And what I'm looking at is the impact in dollar terms across these 10 companies. The area which is below the line basically represents climate damages. And the area above the line represents opportunities, say, which arise from, say, material efficiency or energy efficiency. And what you could see is that the impact of climate change varies across these companies from, let's say around $50 million for MasterCard. Oh no, that's MasterCard right here. To about, say, a little bit over 600 million for Toshiba. So what this graph is saying is that many companies are already experiencing value at risk from climate change. Now, I think it's even more interesting, though, if we jump ahead to 2050. And again, this is the low emissions scenario. And here we're seeing a slightly different picture, where now Google is the company with the highest dollar impact. And I think partly that's due to the really high value of its assets. And Toshiba is slightly less. But it's also helpful to look at this in relative terms. And I'm just pressing that button, which was relative. And if we're trying to get a sense of who's really at risk in terms of earnings, this gives us a good comparison. And here it's saying, okay, Toshiba, 35% of its earnings are at risk compared to 25% for Google. And if you look at the portfolio as a whole, each company has somewhere between 2 to 35% of their earnings at risk. It is instructive to look not only at companies, but different sectors, but I'm not going to get into that. Although if anybody wants to ask me about that, I'm always really game. And then here's one other insight, which is if we look at the lower emissions scenario, and again, we're still looking at the relative impact in 2050 for these 10 companies. There's a reduced sort of risk, value at risk relative to earnings. It's now around 2 to 28% of damages. So, this kind of gives you a sense of, if you're looking at a portfolio view, you'd want to aggregate this across all of the companies to get the expected risk of the whole portfolio. So that's the portfolio view. But it's also kind of interesting to look at an individual company. And here I'm going to take a look at Google and press this nifty thing, and we didn't want that one. Okay, let's look at all the locations. Actually, let's look at this. This graph here is showing us all the assets of Google, or most of the assets of Google, and they're identifying the handful that pose the most risk. So actually, let me flip this back to 2020. And what this is saying is there's something in Mountain View, California, Singapore, and Chile, which currently pose the most absolute risk. And this is kind of a pattern that we see for a lot of companies, especially global corporates. They're all over the world, and so they typically have a handful of companies or of assets that pose the most amount of climate risk. This doesn't change a lot in terms of the kind of that type of profile, but the assets change a tiny bit. So now, if we wanted to understand, I'm going back to 2020, what the risk factors are for the company as a whole. In 2020, it's high temperatures that pose the greatest risk to their physical assets. And in 2050, in fact, coastal flooding starts to take over as the major threat to their facilities. So coastal flooding, temperature extremes, and storm damage pretty much outweigh everything else. And you know, you can look at this over time, but it's in fact, I can, well, this is, I won't do it because it's going to take too much time. But the other thing is we were interested in looking at that Mountain View, California asset. And like the profile for the company as a whole, we can tell that coastal flooding is kind of a big issue for this. And we can actually take a look, we can drill down and take a look at Mountain View, California, but I will do that just a tiny bit later. If we in fact want to look at kind of all the assets as a whole, this is a good way to take a look. And let's see, let me scroll down a tiny bit. Again, this is RCP, the high emissions 8.5 scenario in 2020. And what this is saying is this legend gives you a sense of what the value at risk as a percentage of asset value is for each of these locations. Green is good, yellow is, you know, it's around 5 to 12%. And when you start to get to orange or red, you know, this is, you know, not so great. And currently, so I think it's saying the assets most at risk are Miami, Florida, Istanbul, and then Johannesburg. So now, those three locations each have about, you know, somewhere greater than 25% of their value at risk during this current decade of 2020 to 2029. And then if we go to 2030, the picture kind of changes, and what we're seeing is greater risk in these sort of tropical and mid-latitude assets, which are related primarily to temperature. But in general, we're just seeing a sort of a greater kind of, the movement is from green to, you know, to higher indications of indications of a higher value at risk. And let's just focus right now on Asia right here, because I'm going to move now to 2040, and I think the change is most obvious in that area, where by 20 years from now, 20 to 25 years from now, we're saying, oh my gosh, you know, this is a little bit scary because, you know, many of Google's sites, if we are following this pathway defined by RCP 8.5, many of their sites are really at high risk. I'm going to just now contrast that to the lower emissions scenario. And you can see that there's still quite a few areas that are, you know, at risk, but, you know, I think it's, you know, overall there's more which are in that median band of 12 to 25% of their assets at risk. Okay, I am now going to stop sharing my screen and go back to just, I wanted to just sort of sum up. Now, the point of this all is actually not to sell you this platform. The platform was really to provide some visuals, I think, which are kind of helpful to think about. And in fact, we're replacing this particular platform in a couple of weeks. But it's really to show you what kind of insights arise from being able to model a portfolio, model a company, and look at its assets. And so I think what this is saying is an investor definitely wants to have a view to climate risk in their portfolio. You want to have a comprehensive view of all the different pathways. You want to have a dynamic view of risk as it evolves over time. And you want to have a full range of the time horizons, and taking into consideration these different climate damage pathways. You also want to have, you know, you would want to have leeway to consider a number of different scenarios because the future is uncertain. And I think it's also really important to understand the climate risks that individual companies within your portfolio face, and have a high degree of transparency into the specific locational vulnerabilities. And that's important so that, you know, you can engage with management and understand how proactive they are in addressing some of these vulnerabilities and risks. overall, climate risk analytics is a really dynamic area, and the knowledge is progressing really rapidly. You know, the climate service, which where I work, we are developing new products and all that stuff, but we've had a great deal of luck working with different asset managers and companies to enrich our understanding and tailor our analysis, so that we've been really fortunate that way. So just to sum up, please keep watching this space. Thank you so much for attending, and the best is yet to come with Stacey. Thanks.
Thanks, Therese. It's lovely to be here, and thank you to the Impact Capital Forum and to Scott for all of your leadership on this question. Predicting the impacts of climate on impact investments. When I was asked to join with Therese to give a little bit of insights into both our work and our thoughts on the question, I thought it was going to be challenging to follow such a rich presentation from Therese and the Climate Service. But I will try, and hopefully we will have a rich discussion, and please feel free to ask questions, raise your hand or use the chat box to ask us questions. I am going to share my screen, and let's see, oops, 1 second. Let me see, there we go. I think I didn't do it. All right, let me try again. This technology. Let's see. You guys see that?
That's good.
Oh, okay. Well, maybe I'll start back here. Hi, everybody. My name is Stacey Swann. I'm the CEO of Climate Finance Advisors. We are a consulting firm that we're about 5 years old. We started in 2015, and we are a women-owned business, and we work at the intersection of climate and finance, and our staff and our partners are all practitioners from the financial sector. So we are an outfit that is full of bankers and private equity professionals and development finance practitioners. And our work really is around bringing practical solutions to the questions that our clients have around climate change, how to manage some of these risks, how to capture opportunities to be more, to invest in more climate smart and sustainable ways. I'm very excited to be here. So I will jump forward to pick up on what Therese started, which was really an explanation around what has become a fundamental necessary condition for almost all investors who are thinking about addressing climate change. Used to be 20 years ago that if you were an investor thinking about how to do more investments that were climate smart or sustainable, you were looking at renewable energy, you were looking at reducing emissions, you were looking at sustainability in terms of your energy mix. But what has become very obvious and clear in the last 5 to 10 years has been that we actually have quite a bit of climate risk to manage, and a number of those risks come from the baked-in warming that we've already locked in and the impacts that those will have, regardless of how fast we accelerate our path to meeting the Paris climate goals. So here we are, and we have a lot of investors who are very interested in getting their hands around the issues that climate change brings to them. And we've had a blossoming, I would say, of tools and analytics and data companies that can help us with what we think are the necessary conditions to having a good climate risk management approach that can help you be a more sustainable investor overall. After all, every investor is not just looking to maximize opportunities, but is also inherently a risk manager. Risk is risk, and every investment is structured around a risk-adjusted idea of how much returns you want, what your time horizons are. And addressing climate risk is not only will increase a firm's strategic advantage, but will also unlock numerous opportunities for long-term sustainable growth. And important in that is really the issue around how to identify your risks, quantify those risks, assess those risks, and then use that information to help you develop a better strategic plan, a better operational footprint, a better physical footprint, and also importantly, how to strategically invest your portfolio or invest your balance sheet and build a sustainable portfolio. So one of the things that we do at Climate Finance Advisors and that we've started doing in the last couple of years is really helping our clients build off of the knowledge that they have around climate change and the information that they can get around identifying their risks, assessing their risks, and quantifying their risks, and using that to make more strategic operational decisions and financial decisions. What's important about what Therese was explaining in her presentation is that it actually is quite complicated. What hazards impact your operations, your supply chains, your customers? It's very contextualized and it's very localized. And for some investors, thinking in that very micro way has not been part of their approach for investing in, let's say, portfolios. So the new tools and the new analytics and the work that the Climate Service is doing really does help investors bring some of that information in-house so that they can better assess their risks, figure out how the risks impact the operations of the investments they're going to make over the time horizons that are meaningful for their investments. And that varies by investor, of course. Some investors are more short-term investors than others. Some investors invest in the life cycle of an asset at different points in time. Greenfield infrastructure investors will have a very different climate risk assessment approach than investors who will come into an operating asset that has been operating for many years, where revenues are fairly predictable and for which climate risk needs to be built into that revenue projection assessment. And then the next step, as Therese rightly pointed out, is understanding that information from a value at risk perspective. So what impacts do those types of risks have on revenues, assets, and costs? And again, over what time horizons? And this process is important to do at the asset level, at the portfolio level, and for various different types of financial instruments, equity, debt, other types of instruments that investors might be making. So this is all to kind of paint a little bit of a picture that, you know, different investors may need different types of climate risk data and analytics, and having a flexible tool that can help in terms of time horizons, in terms of understanding and unpacking revenues, assets, and costs is pretty important. Once you have that, of course, then you have the ability to start thinking more strategically about where you make your investments, or what types of assets you want to invest in. If you are working with listed equities or with asset managers, what types of questions you're going to be asking those investees in terms of information that you need in order to make those assessments, and how to potentially shift your portfolio and shift the way that you strategically place your funding or invest your money. And that is something that is we're starting to observe that happening across all different types of financial actors, regardless of what they invest in. We're starting to see everybody wake up to the question of climate risk. And we're starting to see many of those people, many of those investors who are waking up to the question of climate risk, really starting to roll up their sleeves to get their hands around quantifying this. And primarily, this is being driven by a desire to impact returns and a desire to ensure the kind of portfolio that they are managing or that they're investing in is sustainable over the long run. However, as many of you on this call also know, the Task Force on Climate-Related Financial Disclosures, which was established in 2015 in Paris and launched its first report in June of 2017, and has become somewhat of an industry framework and lexicon for understanding climate-related financial risks, has also been driving a number of investors and a number of assets to start thinking about climate change in a new way. Those that are focused on the disclosure part of it also need these types of tools. It would be very difficult to disclose something that hasn't been identified, assessed, or quantified. And most investors and most asset owners that we know also want to unpack and understand and have a strategic vision around how to manage those risks. So we see the process of identifying, assessing, and quantifying risk using tools, data, and analytics that Therese has presented here as a necessary condition for the strategic planning that you need to do to be able to manage risks, to think short-term and long-term about your planning, and then have an approach which is distinct around disclosure, both disclosure to your investors and disclosure in the public markets as well. I see there's a question. So it looks like it's for you, Therese. Maybe I will turn it back to you to answer this question. Does your model take into account the value at risk of intangible assets, given the fact that intangibles are valued far more than tangible assets for S&P 500 companies?
It's, maybe I should just take that at the very end. Is that okay?
Sure.
I think it's a really great question, but I don't want to interrupt the flow of what you're discussing.
Yeah, I was just getting to the end of it, so I was hoping we could have a bit of a back and forth. But just to wrap up, I will say one of the things that we're excited about at Climate Finance Advisors is really seeing the development of the data and analytics space, but also the application. We are starting to see a number of firms and investors really roll up their sleeves and get their hands around the data and analytics that are necessary to be able to manage these climate risks more fulsomely, to be able to think about this from both the value at risk perspective from a risk management side of things, but also from the opportunity side, because there's a number of investors who understand that addressing these risks does bring the ability to identify greater sustainable opportunities over the long run. One last thing I will say, one last observation I will make from what we're seeing in the industry is that there still seems to be a little bit of a confusion, or confusion may be the wrong word, but a little bit of a confounding of ESG risk versus climate risk. And we like to, we often talk to our clients about the distinctions between the two. A number of ESG approaches are often looking at climate risk from a very narrow perspective, in particular around emissions and footprint and what the asset is doing to the environment. But climate risk is broader than that. And what Therese and her team are doing at the Climate Service and others who are working on this issue are really looking at what the climate impacts do to the asset. And if you are using ESG as a lens, just be mindful that you may need to ask broader questions because some of the ESG frameworks and some of the ESG lenses that are out there really are not comprehensive around the climate impacts to the asset. That's a very important point in overall risk management.
Great.
Therese, I'll turn it back to you.
Sure. This is a great question, and one that I actually thought about as I was coming on to the climate service, which was actually a couple of months ago. In general, and I would say, so the question is, does your model take into account the value at risk of intangible assets, given the fact that intangibles are valued far more than tangible assets? And in general, we do not take into account intangible assets, except where they are truly baked into some sort of physical asset. And so the reason for this is, IP is generally not confined to a specific location. Even something like pharmaceuticals, you would say, oh, well, that factory is dedicated to producing, this particular drug. And yeah, it might be, but you can probably construct another factory that's going to do that. And the other thing is, like, if that drug, suddenly goes off of its patent and it's sharply reduced in price, then that asset's kind of different in value now. But the only time that we actually put what would be considered kind of intangible assets into or tried to assess a value was in cases like Disneyland, because in fact, the realization of Disneyland and other sort of theme parks, where the realization of some particular experience or vision or whatever you want to call it is actually really in the asset itself. So that's generally a pretty exceptional case. It was actually really fun to think about, but it's a great question, and in general we do not. So I would love to have any other questions or even, kind of comments, asked.
I think you have another question coming in.
I think Haben just been saying.
I have a question. We do encourage questions from our attendees. Please chime in. I have a question, one for each of you. For Therese, the data model, I'm a data guy. The data model is impressive. And I wondered if you could comment, one, on what kind of effort level does it take to maintain that granularity of data? And on a related note, what are the challenges trying to get the measurements relatively precise or useful enough?
Really great question, Scott. There is a huge amount of effort, and it's, if you look at each of the stages. So actually, we have, for instance, our data guru, who has done a tremendous amount of work, which is now kind of encapsulated in sort of wrestling with all the different climate models and getting them into a sort of coherent form that can be represented in our platform. So fortunately, that work is mostly done, although the interesting thing is that there are a number of different variables that are being added at this very moment, because we've started with a range of variables, but now we add things like pluvial flooding, which is kind of like inland flooding, and so if the point is to really get as comprehensive a representation of all the climate risks, there's just a very large range of different variables that you want to capture, and some of them are very well tied to the climate models that have been created, and others are sort of a much more of a localized kind of issue. So that's one thing. To be perfectly honest, as you look at a company, especially for some of these global corporates, getting a good fix on all their assets is actually quite difficult. And so that requires a huge amount of work. That it requires engaging with, say, outside data sources and so on, but it also, there's a lot of just, going on the web and trying to find where, in fact, different assets are, because, for many companies, they don't really want to disclose where their data centers are, where their transmission and distribution lines are, where their manufacturing plants are. So you need to do a lot of research on that. And in fact, for instance, sometimes you end up getting data from some very unusual sources. So that is a second area that's quite demanding. And then in terms of developing what the impact or vulnerability functions that I described, that also is challenging because, there is frequently not a lot of data associated with these acute events like hurricanes and storms and their effect on different assets. So yeah, and I see that Dee has asked, is there enough data for publicly traded companies at the asset level? So that is a really good question. I think there is, but in certain cases where it's missing, we will rely on creating something of an asset profile because we recognize that there are certain patterns for companies in different sectors. That's a really, we prefer not to do that. We prefer to rely on empirical data as much as possible. But there are some situations where, you really cannot find anything. And for instance, if it's a private equity investment where, that could be really challenging. So it's a very good question about the adequacy of data. I don't know that anybody has a really great answer for that, but everyone is, in fact, I just went to a conference this week, which talked about that and all the different ways that people are trying to approach it, whether it's with, all the search methods that I just described, satellite imagery and using, artificial intelligence to try to guess at things, or using, natural language processing to try to comb through, text as quickly as possible. So there's lots of different ways people have thought about this and are trying to tackle this problem. So it's a great question. Were there, Scott, did that answer your question, or were there other?
That did. Just on a related note, how does the data model typically get used at an institutional investor? Is it directional? You're eyeballing it and you're creating conversation around that, or is it actually a data set, a model that they import and they use to affect their own risk models?
Yeah, we're evolving to the point where financial institutions are going to be able to pull that over into their actual models. Right now, what institutions have asked for, ooh, sorry about that, are, can you give me a sense of, for this company, what's the impact going to be? And, so basically we let them pull it into their own models. We just do the modeling of the impact. And that's sort of been the kind of the junction point for the work we do and the work that they do. Some other ones I think are looking for a little bit more extended, kind of like, can you now, give me a sense of what the pricing is for this and this instrument. So, we're getting to that point where we will have both the facility to, talk about or to actually specify the impact, whether it's at the asset level or the physical asset level or at the company level, as well as be able to tell them, at least this is our take on what pricing will be for this instrument. And John Myers asked about, are we looking at epidemiology and disease transmission through the climate impact lens? Is that something you want to take, or do you want me to take it? I don't know. I guess that's probably not your area, Stacey.
Well, yeah, epidemiology and disease is not my forte at all. But I will take the opportunity to answer or to kind of add to your comment to Scott's last question, and then maybe talk a little bit about what we're seeing in terms of investor sentiment changing around climate risk because of COVID. So Scott, just to kind of maybe take your question a little bit deeper, we do a lot of work with financial institutions who are thinking about ways to bake into their investment process the climate risk management approach, right? So it's not just at the financial structuring stage or the credit analysis, but also even earlier on in due diligence and appraisal. What kind of information do they need to get from the investee company in order to feed into a tool like what TCS has in order to help them with their credit analysis? And at the credit analysis stage, it gets a little bit more complicated because obviously you have a number of different things that go into the risk matrix. And climate can be its own thing, and it can also exacerbate other things, although that is true for a lot of different items on the risk matrix. Not all items are singularly kind of able to be scoped aside. So, but where that's happening, that's really exciting, because what that means is that is both a ability to quantify the value at risk from certain types of climate impacts that might have been assessed deeply in the financial model of the project, but then also the financial structuring, so the pricing of different instruments, whether it's debt, equity, guarantees, or even in the column of management, well, how do you manage climate risk? Insurance is one of the tools in the toolbox to risk transfer. And so we're seeing a number of institutions try to get their hands around this. Obviously, it's not, for those of you who work in financial institutions, it's very unusual to change an investment process. So these things take some time, and you have to really kind of, you really have to prove this and show it and kind of demonstrate it, but it's good to see some movement on this front. I will say one thing that we've also observed in the process that we've been involved in with some banks on this is that it also tends to be somewhat distinct from the portfolio management side of the house, which is really important, because risk is not just a snapshot in time when you make your investment. It's every day, all day, every month and year, and so on. So we're also seeing a number of institutions starting to understand, for various reasons, whether they're driven from a TCFD perspective or they understand that the best way for them to manage risk is through their portfolio management practices, but to understand that having a tool that's ongoing in portfolio management is really important. On this question around epidemiology and disease transmission, I can't answer this question at all. I'm not a climate scientist, and I'm a finance person who does climate. But I will say we do perceive that there is some change or changes afoot in investor sentiment around climate risk in particular, because of the collective experience that we are having. I think it's stronger among some parts of the financial community than others. Certainly the parts of the financial community that have anything to do with a public balance sheet. So you see this from the folks who are talking about green stimulus in Europe, but also at the IMF, but then kind of moving down the financial ecosystem and into the development finance institutions and even local financial actors who are driven by a public mission. Either in the United States, we have something called Community Development Finance Institutions, CDFIs, which are kind of local financial institutions and meant to be community development banks. There's a lot of activity around the climate, addressing climate as part of the post-COVID recovery from that perspective at the bottom up. So we see a lot of this, let's say, awareness and change in sentiment from the financial parts of the financial sector that might have some linkage to either a public mission or a public balance sheet or a public delivery of services, even the private ones, the ones who are driven by commercial returns. So I know that doesn't answer the epidemiology and disease transmission question, but I think it kind of gets a little bit to the COVID impact.
That's super interesting, Stacey. Just to answer John, we currently don't do that. I think that's definitely something we would consider going forward, because, we just gone through the last couple months, and that is, so I think it's a great question. Yeah, but we're focused on other things right now, but I think that's something we would really like to be able to do. In terms of Haben, I don't know if I'm pronouncing your name correctly. I think there are definitely certain sectors that are very exposed. Utilities can be things that have sort of network, large physical networks where there are assets that are externally exposed, or say companies that have extensive supply chains. I would say, however, there are some surprises when it comes to different companies, because you will see you know, very proactive adaptation and attempts to mitigate climate risk. So even though you can say, well, this sector, you know, well, I'm just going to avoid this altogether. I've been surprised at how, you know, how thoughtful a number of companies have been, and even in places like the utility sector, where there's, you know, they may be very concentrated in a certain area, but recognizing that they've gone to, you know, to move from thermal assets to, you know, renewables across the United States, and even invest in, say, battery storage. So, you know, I think there's a lot of good thinking going on there. And then the last question with regard to data resolution, this is a really good question as well, which I don't have a great answer for, because I think you are quite right talking about flood and wildfire as being, you know, those are especially difficult to to model well. You know, the question is, do you model by, you know, I think we don't go down to the engineering kind of level, which is what I think in many cases you would need to do for, say, for flood, for really good flood modeling. You know, so, and then I think wildfire has this kind of, you know, an aspect of not exactly randomness, but that's a, you know, the pathways are pretty difficult to model. But I think, you know, we're sort of trying to get at an overall sense of risk, and therefore, to the extent that we can capture what are general for you know, for certain variables, I think we can do a pretty good job for temperature and drought and so on, or even storms and so on. But those two, I think, do pose some specific risks. But again, we're trying to get a sort of a general sense of what the risk will be. So that's, you know, I guess I would say that's a space in which, you know, further work will continue to be done. And thank you, that's a really good question. Any other questions? Or Stacey, I'm happy to, you know, if you have any comments.
I have a final question for Stacey, and then we'll leave folks with your website so that they can learn more. Stacey, you must work with a variety of institutional investor types, whether it's pensions or family offices or buy-side firms. Do you see patterns of engagement, what they're trying to get out of the process, and, you know, how much of that is a proactive goal of changing the world as opposed to just trying to see where the risk lies?
Great question. I think it, for sure, there are definitely some institutional investors and pension funds who are looking and being challenged by their members to be more proactive on this issue. Some of them are more or further along than others in terms of what they're doing about it and how they're tackling it in a real tangible way beyond the commitments that they're making to the Paris Agreement or the like, right? I think of the landscape of investors, my sense is that they're also the ones who are starting with the qualitative gathering of information first, as opposed to the data side. Although I could be mistaken, and again, a lot of investors, when they're looking at data and analytics like what TCS has, don't really advertise it until after they've tried it and adopted it. But our observation really is that from the landscape of investors, the institutional side is really still at the qualitative questioning, trying to get information from their investee companies, doing some analysis, some portfolio analysis that is, or, you know, risk analysis, but on timeframes that are more consistent with, you know, 30 years out, 50 years out, as opposed to the kind of use case that a data and analytics tool around climate risk would give them from a, you know, a day-to-day risk management perspective. I don't know if that's helpful.
Thank you for that. That was helpful. Thanks to both of you for sharing your tremendous expertise. Obviously, the climate is an issue that's not going away. And in fact, we need to get better with the data, the understanding, and the actions to be more targeted. So we appreciate this session today. Folks, you can reach Therese at theclimateservice.com and Stacey at climatefinanceadvisors.com. And for those who are interested in the upcoming webinars, please come back on 6:30, June 30th, with Steve Glickman about Opportunity Zone Regional Development. Thanks to you both. Thanks for everyone for joining. See you soon.